Good afternoon, everyone, and thank you for joining us for this webinar today. My name is Emily Hallams, and I'm the Executive Director of the Australian New Zealand Chamber of Commerce in Japan, and it is my pleasure to welcome SMATS Group Executive Chairman Steve Douglas for a Q&A session today, where he will answer your questions regarding changes to capital gains tax and how this may affect Australian expats. We're the leading provider of Australian taxation and mortgage services to Australian expats, foreign investors, intended migrants. SMATS was established in 1995 and has since expanded to include offices in Singapore, Hong Kong, London, Dubai and New York, with representation in China, Malaysia, Thailand, Vietnam and Indonesia. Steve became co-founder and managing director of Australasian Taxation Services in 1995 and is a specialist in non-resident property investors, migration and expatriate taxation planning. And as many of you would have seen, he and the team at SMATS Group have produced a range of online seminars available on their website, providing free advice for Australian expats and regular market updates. So those of you joining this webinar today will have no doubt watched Steve's video on capital gains tax already, but I recommend having a look at all the other content available on the SMATS Group website. So legislation to introduce new laws affecting capital gains tax on former homes of expats was passed in late 2019 and will go into effect from June 30th this year. Previously, anyone who had formerly lived in their property was entitled to capital gains tax free status, but from June 30, anyone who sells their previous home while living overseas will find the full capital gain subject to tax. With the added complication of COVID-19 now potentially preventing expats returning home to Australia, before this June 30 deadline, we are grateful to have Steve here to shed some light on how property owners can best navigate this issue and avoid potential tax implications. So finally, it is a pleasure to be hosting this webinar in collaboration with ANZCham Taipei, AustCham China, Beijing, West China and South China, and AustCham Hong Kong. So I want to say a big thank you to the teams at these chambers for working with us to put together this webinar today, and welcome all the Taipei, China, Hong Kong members who are also joining us. Now, more than ever, it is important to stay connected, so we're very glad to have this opportunity to come together with you all today. On that note, I think that is more than enough from me, so I'll now hand over to Steve to give us an overview on capital gains tax changes before we begin our Q&A session. So please note that questions can be sent through the chat box function by clicking on the speech bubble icon below, or feel free to email us directly at info@anzccj.jp. That is info@anzccj.jp. Thank you, and we'll hand over to you now, Steve.
Thanks, Emily. Welcome everyone along. And special thanks to the four chambers that have got together and put this online. And I suppose with every crisis does come a silver lining, and you can see it'd be a bit impossible to do this as a collaboration in the old days, but this is the new norm. So we're all sitting at home nice and relaxed, no worries about traffic because it doesn't exist anymore, and we can do this. But as with one thing, you get some good and you get some bad, and of course the capital gains tax is a red hot issue right now for expatriates, and has been probably since it was announced in the 2018 budget, and we fought it very heavily. And a big shout out to Jacinta and the team at AustCham in Hong Kong, who are champions of the cause and managed to get it altered and delayed to the May 20 deadline. But we'll have a bit of a chat. Obviously, I do hope you were able to enjoy the video session that we put together and went through quite a lot of detail. As in that presentation, and just to start this one, legally we just have to do a quick disclaimer, not because we're not going to give you good advice, but purely because everyone's situation is so significantly different. You can't take general comment, and we see this ironically in the modern version of Chinese whispers, where everybody takes the little bits that suit themselves and try and adapt it to their circumstance. But believe you me, there's a lot of misinformation going out there in regards to this. So hopefully the video and also today's session will help you all. But bear in mind, you have to get specific advice to your situation because it is quite complicated. Before we take questions, I just thought I'd do a quick rehash of the key elements, just in case someone didn't see the video, or as in my experience, many people watch the video and get very different interpretations out of it. But just a quick reminder that this change is affecting only a property if you've lived in it previously. So if you've got investment property that you've never ever lived in at all, then there's no impact on that whatsoever. The rules are the same. It also doesn't impact you if you manage to sell your property in the future when you are living back in Australia. So that's the government's main defence as to why they think this is a fair and reasonable change, is they say, no big deal. If you're back in Australia and you sell, there's no issue to you. So that's something to bear in mind. So it certainly means that you don't want to be selling unless you are back in Australia. The extension of the exemption through to June 2020 was important. As it turns out, with COVID, the world's most unknown and unforeseen event, that's now becoming problematic. So what happens is, basically, in a nutshell, change means if you had lived in your property for any amount of years, even 20, 30 years, and you move overseas and you sell it even 2 or 3 weeks after taking up an overseas assignment, any previous time lived in the property is excluded and you are fully taxed on the entire historic profit. That's a very, very unfair, change. But again, the government's saying, oh, look, you could sell it now before June 20, or if you don't sell it till you go back, no impact, so no big deal. Importantly, the June 20 is based on the contract date, not the settlement date. So if you can and wish to sell, do it on paper, get it signed off before June 20. Of course, with COVID, that's going to be extremely hard to do. Selling a property right now is difficult with lockdown. We've just seen, just in the last day or two, Queensland and West Australia relaxing the rules in regards to home opens and displays. That's likely to be extended into Victoria and New South Wales in the not distant future. But one small uplift in the contamination rate will change that back, and everyone will go back into lockdown. So it's going to be a very, very interesting time in doing that. We've got an ability that if you're worried that you can't sell your property by the 30th of June, you could look to sell it to a related party, i.e. from husband to wife, wife to husband, or indeed we could look at a family trust or a family company if that was justifiable. Now, there'd be limited circumstances that would be the case, and usually it would be if you were pretty sure that you would sell the property while living abroad and you wouldn't be able to get back, and you had a substantial historic capital gains tax free amount. So if you would own the property for many years and you were absolutely sure that you were most likely to sell the property during your future time abroad and not be able to wait till an expected return, then selling it into a company or a trust is highly advantageous. Again, needs to be considered because there may be stamp duty considerations, there may be some capital gains tax triggers. So you'd need to look at your personal situation, but something to consider there. The government, was kind enough to concede some exemptions for death, divorce, and financial hardship. Interestingly, COVID-19 might be able to be used as a catch-all for financial hardship, because even if you haven't lost your job, it's probably arguable that you've had financial hardship as a result. Whether the definitions of financial hardship are going to be widened or whether they're too narrow, that's going to be an interesting and subjective argument over the coming years for people that may get captured in this new change and end up paying tax and try and get out of it under the financial hardship rules. Basically, the bottom line is you need to say, well, do you need to sell your property after 30th of June? And are you likely to be overseas in that time? And if so, bringing forward that sale to pre-30th of June 2020 is certainly an important thing to consider. So you've got to try and assess that. Now, it's very, very difficult to know for sure. There's lots of different factors, including children's schooling, need for the cash, upgrade, lifestyle. There's a million different elements. So, you can have a chat to someone like us who's obviously had the experience to go through life events with many, many different people, and we can quiz you and interrogate you and find that out, but see how you go. Fingers crossed we may be able to push the government, which I know we're all trying hard to seek an extension of the June 20 deadline up until maybe 1 year or 2 years, or the end of the COVID mess, which could be even longer. So that's going to be interesting to see if that happens, but I wouldn't guarantee it. It was a very, very difficult task to get it deferred last time. Whether we can get 2 for 2, that's going to be a minor miracle. And of course, what you will look at is if you are thinking that you need the cash out of that property for a future purchase, you might want to consider very quickly whether you can access that equity through finance as opposed to sale. Particularly if that sale is going to trigger capital gains tax, or other issues soon after June 20. Borrowing against the money and having that available might end up being more advantageous than selling and paying tax. So there are other options to access the wealth in the property as opposed to selling, and you certainly would be encouraged to do that, especially now that interest rates have gone down so low. I mean, we're the lowest in the history of Australia. So how long that lasts, I don't know, but I'll be certainly making hay while the sun shines and doing what I can to help out there. So they're the key elements in summary for you all. Hopefully that sort of gives you a little bit of overlap onto your personal circumstances. But Emily, I'll pass back to you and we'll happily open it up for questions now and see what anyone needs.
Thank you, Steve. That was a very clear overview. Thank you, and a good start to our session today, I think. Just as you were speaking, I know you touched on COVID-19 and how certain areas of Australia were relaxing restrictions on open homes and that sort of thing. We've had a question come through asking if you're expecting an increase in properties on the market now before June 30th.
Yes, I think there's a situation where we always expected there would be a flow. My experience would tell me that most people that were going to sell probably would have already. Again, I think it's a question that if people go and assess their situation logically, they're probably more willing to keep the property until they return. So I've got a feeling it could in fact go the opposite way. I think we could have a drying up of properties for sale because it's now going to get very difficult to sell, especially at a price that would be a willing seller. And to keep the property with interest rates so cheap is now negligible. So I think it would be a very different scenario if interest rates were 6, 7, 8%. And this deadline was looming, but now with interest rates at 2 and 3 and 4%, and the fact that the market is difficult to sell in and the world is in chaos, I think it's going to be a very, very easy decision for literally every expatriate to say, you know what, we'll just see what happens and push it down the line, which I think is going to be problematic for the property market because that supply that people expect usually is going to dry up significantly and then put upward pressure on prices once again.
That is a very good point. So it'll be interesting to see, what happens when life does begin to return to normal and how that'll affect the prices going forward. As you mentioned, the advice of potentially selling into a trust for those who are looking to make this deadline. We've had another person write in asking, in terms of selling into a trust, if distributed to an Australian citizen who is also a non-resident for tax purposes, are the capital gains exemptions still valid?
Yes, in regards to owning in a vehicle, a trust or a company or anything of that nature, there's very limited circumstances where you can still get the principal residence exemption. So as a general rule, I'd say to you that you would not get a capital gains tax-free distribution under the residence rules if it was coming out of a trust. And hence we would always recommend that if it's a property that you intend to live in when you go home, you would not put that into a trust. The only ones that we would probably put into a trust is if you were very sure that you lived in it before happily, but when you go home, you're going to change its style or change its location, what's commonly referred to as downsizing. Many people when they left Australia, they just finished with their kids and everything, so they had big houses. By the time they go back, they'll probably be in small apartments. So the small apartment that they live in, we would not put in the trust. The old house, if they wanted to keep that as an investment, that would be the one you'd put in the trust. But if they did consider that they were going to live in the old house when they went back, you'd be reluctant to put it into the trust because you would lose any future capital gains tax benefits.
Okay, that's an interesting point you make there. Coming sort of back to, as you mentioned, families who perhaps kids have grown up and left home and they've moved overseas after that point. I imagine there are probably some who still have family members, whether it's kids or other people in the family, still living in these properties rent-free. Would the capital gains tax still apply for those people if they sell after June 30?
Yes, unfortunately, they're probably one of the groups most harshly exposed. Under the old rules, if you moved out of your home and rented it out, you would still get capital gains tax free for up to 6 years. Now, in circumstances like you mentioned, where the kids would stay in there to study, or it would be not rented, that 6 years didn't apply. The house remained capital gains tax free indefinitely into the future. And then once it started renting at some future time, another 6 years would apply. So they're the probably group that's going to be hit the hardest, are the ones that, have their children or are not renting it out, keeping it as a holiday home, for example, where they would have still been enjoying capital gains tax free throughout. That's now going to become a taxable asset when they sell it, if they're living abroad at the time of sale. So they are the most harshly dealt with.
Okay. Do you find in your dealings with clients that most people are really aware that such a dramatic change is taking effect, or have you found a lot of people that just aren't aware that these things are happening?
Well, sadly, I think ignorance is always the winner on the information stakes, and either people have heard a little bit about it and are misunderstood, or don't know at all. And it's usually only through chat groups like this, the chambers. Obviously, we have quite a large client pool that we try and keep up to date and informed, but it's still unfortunately up to the individual to find out. And hence, we're taking quite an aggressive role in doing these sorts of information pools, because the worst thing that could happen is someone didn't know about the rules, innocently sold their property, thinking about, oh, I knew it used to be like that, and then making a substantial gain and being told, oh, sorry, you've got to pay tax on that. And you could imagine the devastating effect would be if you were only going to be moving back to Australia in 6 months anyways. You've had the property for 20 years and you were 6 months away from returning, didn't know, and sold the property, and if you just waited a little while, you'd have been fine. And hence, it's very important that we get the message out, share the message, get it as a dinner table conversation, get it at the chambers. And I think we've all done a pretty good job in that. But again, you've got to remember there's 1 million Aussie expats out there somewhere. So to get that out there enough is never going to happen. But we just keep trying. That's all we can do.
That's right. Yeah, I think it's very important that we are doing our best as well from a chamber perspective too, to make sure people are aware of these changes, because, yeah, as you say, that could be devastating for people who may not realise and are moving back home. Moving sort of away from the family home topic, but someone else has written in asking if this current tax-free status applies to personal properties only, or whether it would apply to corporate investments also.
Yeah, again, there's very, very limited circumstances that a corporate entity would be entitled to a principal residence exemption. So these changes would pretty much never have any impact on corporates. Corporate owners would always be taxable regardless.
Okay, good to know. Thank you very much. So I've just had another question come through from, I think you did touch on this in your introduction there, but have you heard of any current moves to delay the June 30th deadline in light of the current circumstances with COVID-19?
Absolutely. I think, I'm glad to report most of the chambers have now mobilised and certainly, have much better access to the treasurer and the likes. The likes of ourselves are doing what we can. There's a few bodies that are starting to push. The danger we've all got in this current time is I think we're going to be fairly low on the priority list. As you imagine, they're busy at hand trying to save the nation from, a pandemic. So whether they'll listen to us, whether they'll be sensible, we hope that we can get in their ear at least, and the chambers are our best chance of that, and hence why we're always grateful with anything that they do. You would think that if you look at the pattern of behaviour of the government and their willingness to provide support assistance to so many different groups in such extreme and massive financial ways, that hopefully we would be somewhere in the pecking order and we would get that extension as logically, being able to be pushed through. My fear is that, again, we're just one of 1 million requests and 1 million demands and whatever. So I suppose the thing we need to be as a community is a very, very noisy wheel right now. You know, we want to squeak like crazy and hope that the government hears us and gives us a little bit of oil. And we don't need much, we just need a little bit of oil. That's all we want.
Yeah, that's right. And I think that is, as you say, a great role that the Chamber communities can play. So hopefully we'll, on issues like this, we can see a lot more opportunities for the Asia region chambers to come together on these topics. So yeah, for yourself, Steve, but for other members as well, I hope you can always reach out to us and let us know if you have these sorts of concerns. So to continue with our questions, we had another come through wondering if do the ruling for capital gains tax, sorry, what is the ruling for capital gains tax on shares?
Yeah, this is always an easy answer for me.
Okay.
If you're living overseas as an Australian non-resident, and that's the important thing, genuinely living offshore, then from an Australian tax perspective, there is no capital gains tax on shares. There's no income tax on dividends or anything. There's only what's called a withholding tax if the dividend from the company does not have what's called a franking credit, which basically means that the company paid tax already. But it's one of the anomalies that here they are, you know, smashing us on the family home, whilst they've let shares be completely capital gains tax free. One of the things that a lot of expats may also remember is that in May 2012, we, you know, as expatriates, anyone living abroad, we lost our 50% tax-free concession on general investment capital gains as well as. So not only are we now losing the principal residence exemption, but we lost the 50% tax-free concession in May 2012, whilst all along share trading has remained capital gains tax-free. Now, having said that, wherever you are, you need to check whether capital gains tax is payable in your country of residence. So it won't be taxable in Australia, but some jurisdictions, you know, will charge you tax in that country. So obviously places like Singapore and Hong Kong, not so much. But if you're in places like Japan, after a certain amount of years, you can have that capital gains tax, you know, smashed in there. So you just have to be mindful that Australia won't tax, but don't be afraid to check your local rules. And, you know, hopefully it's just good news for you, but we just have to see how it goes.
Okay, good to know. Would the same conditions apply for income for Australians working overseas, or will that also come into effect with the capital gains tax?
Well, if you're living again overseas as a non-resident, you're only taxed on Australian sourced income, which basically is going to be pretty much only the rental that you get on your property. Now, if you happen to go and do some work in Australia, you know, not incidental to your normal duties, so it's not that you went down to build business relationships, but you physically went down there for a 3-month secondment, for example, then that would also be taxable, but pretty much everything else isn't. So, you know, from that regards, you know, you don't have to declare in Australia your foreign salary, your foreign investment income, your Australian investment income. You're only literally 99% of the time going to be subject to income tax on the rental on your property and the capital gains tax on your property. So they're the two only elements that you have to worry about.
Okay, that's great to know. All right. So we do have a few questions coming in today, Steve, but we are almost running out of time. So is there a way that Australian expats can get in touch with you directly if they are looking perhaps for a personal consultation? Sure,
they can always visit our website. It's smats.net, and you know, they can log an inquiry on there. We also have live chat, so anything they need, they can do that, and we're always happy to answer general questions without charge, and then, you know, assist them as they need going forward. So, you know, we're very keen to make sure that people are informed, and we'll make sure that they're attended to promptly.
No, that's fantastic, Steve, and I think you guys have been very generous with your time, especially offering those free consultations. So I hope there'll be plenty of expats that take you up on that. I should mention as well, those viewing may have already found on the website that we linked to with the video before today's webinar, but there is also a summary of these changes to the capital gains tax available on PDF form on that same link. So if you would like to check any more of these details, you can have a look through there as well. And I think we spoke earlier today, Steve, but do you have any future events coming up of this nature that people could access?
Yep, we'll be running a whole series of seminars and videos throughout this COVID situation. I mean, you know, I'm sort of feeling a little bit duck out of water at the moment. I usually spend 30 weeks traveling, presenting seminars and everything. So for me to be stuck in a single, you know, destination and told to stay in the cave, it's very unusual for me. So fortunately, we've been doing the videos for many, many years. So it's a great way for people all over the world to get access. The budget usually comes out in May, but that's now been postponed because of the significance of the financial impact of COVID through to September. Fingers crossed, by September or October, maybe we'll be allowed to travel. But at this stage, that's a 50-50 at best. But if it is, I'll be the first guy at the airport, I can assure you, off to do seminars wherever we can. But it probably looks unlikely that any of us will be able to do normal business travel as we used to know it, possibly until 2021. So video is definitely going to be the distribution method for us and many other organisations. So yeah, look out for those. And the good thing is you can catch up with them at your own time, in your own place, with a nice glass of wine in the company of your lovely spouse.
Oh, it was a great sales pitch there, especially on the end. Thank you, Steve. Hopefully we'll be able to welcome you back to Japan again soon, but I hope we'll have more opportunities to host these kinds of events in the meantime. Look, we're nearly out of time for today, but before we go, I'd just like to say a huge thank you again to Steve for taking the time to share your knowledge and expertise with us today. This is a period of a lot of change and a lot of uncertainty for a lot of people, so I'm sure I speak to everyone at home when I say that your insights provided much more clarity for us. So I'd just like to remind you all again that you can access more information on this topic and other tax and investment topics at the SMATS website. Alternatively, you can also reach out to us at ANZCCJ and we will happily connect you with Steve and the team. Is there anything else that you would like to share with us before we head off today, Steve?
I think I've given you everything you need, but just my best wishes and hope that you all stay healthy and happy, and hopefully that this doesn't go any longer than necessary, however long that may be.
Exactly right, and I hope we'll be able to meet in person again soon. But in the meantime, thank you so much for today, and thank you to everyone from home for joining us.
Pleasure. Bye-bye.
Thank you very much. Bye.